The commercial real estate markets have gone through some pretty major changes over the last few years, with increases in remote work affecting office investors, record high supply growth affecting the multifamily and industrial sectors, and some of the fastest increases in interest rates we've ever seen, causing huge drops in transaction activity overall. And with so many different things going on right now, in this video, I want to walk through the latest information on what's happening with the four major commercial real estate property types today, how the recent news around tariffs could impact this business, and what all of this could mean for investors and industry professionals throughout the rest of this year. So to start, let's look at what's happening in the office sector first, which has arguably been the hardest hit property type over the last 5 years. And today, we're finally starting to see a little bit of relief for office property owners, with 4-quarter rolling net absorption in Q1 of 2025 increasing by 30% quarter over quarter and jumping by 48% on a year-over-year basis, according to Cushman & Wakefield. And while a portion of this is the result of office demand picking back up, incoming supply levels in this sector have also tapered off a lot over the last 12 months, with just over 26 million square feet of office product currently under construction, which is less than 20% of the incoming office supply under construction we saw back in Q1 of 2020. In the first quarter of this year, new deliveries also reached the lowest quarterly total we've seen since 2012, at the same time that sublease availability in this sector dropped by 9.5% year over year. Now, the national office vacancy rate is still sitting at over 20%, so there's still a long way to go before supply and demand in this sector find a more sustainable long-term balance. But for the first time in a while, we're beginning to see this asset class trending in a pretty positive direction. Now, moving on to the industrial sector next, which has been one of the strongest performing property types over the last few years, we're starting to see some headwinds that are causing growth to slow. According to Cushman & Wakefield research, in Q1 of 2025, industrial net absorption was down by almost 46% from Q4 of 2024, and industrial vacancy levels jumped up to 7% nationally, with rents staying flat in this sector on a quarter-over-quarter basis. Now, the bright side here is that a lot of this slowdown that we've seen in recent quarters is due to new deliveries spiking considerably in 2023 and 2024, but today that trend is starting to reverse course. In Q1, there were just over 72 million square feet of new industrial deliveries, which represented a 41% year-over-year decrease, and the new construction pipeline dropped to 270 million square feet, representing a roughly 60% drop from the space under construction we saw at the peak of industrial supply growth this cycle in the middle of 2022. Now, if we start to see material increases in costs due to rises in tariffs or consumers pulling back on spending due to fears of a recession, we could see these vacancy levels continue to tick upward. But as of today, the industrial sector still feels relatively healthy and seems to be headed in a positive direction. Now, if we move on to the retail sector next, this is an asset class that has performed surprisingly well in recent years, but cracks are finally starting to show in this sector in a few different places. According to Cushman & Wakefield research, the national retail vacancy rate rose by 20 basis points year over year to 5.5% in Q1, and retail net absorption at the national level came in at a negative 5.9 million square feet. This was the biggest quarterly drop we've seen in this sector since the third quarter of 2020, and even though year-over-year rent growth was still positive in Q1 at 2.3%, the pace of rent growth in this sector has slowed down a lot over the last 18 months. Overall, there are a lot of question marks right now for retail occupiers, since trade policy changes can have big impacts on the cost of goods and the price of goods to end consumers. So while supply growth still remains pretty minimal, the near-term future for retail property investors is very much up in the air right now. Now, moving on to the multifamily sector, this product type now appears to be bouncing back after dealing with a lot of incoming supply over the last few years. New deliveries of multifamily product in Q1 dropped by 25% year over year, and trailing 12-month construction starts dropped by 36% year over year, resulting in vacancy dropping by 10 basis points quarter over quarter, and rent growth also showing a slight improvement, up over 2% year over year. And similar to the supply story in the industrial sector, multifamily units under construction peaked in late 2022 and early 2023, with the pipeline dropping by almost 50% from that time, and with consumer confidence dropping significantly in April, and the cost to buy a home still significantly higher than the cost to rent in many major US markets, the near-term prospects for multifamily investors seem very strong heading into the rest of the year. Now, the wild card here for virtually all product types today is trade policy and the tariff increases that were announced by the Trump administration earlier this year. And while the impacts of these and the finalized changes that would actually be implemented aren't set in stone right now, there are a few main things that would very likely be impacted if things were to go through as planned. And the first thing is that if the cost of goods to businesses rise due to tariff increases, those costs would very likely be passed on to the end consumer, leading to increases in prices and as a result, a potential drop in retail sales. And a drop in retail sales, or even the threat of this potentially happening, could ultimately lead to a decline in retail leasing demand and also a drop in demand for industrial warehouse space if e-commerce sales also start to drop. And on top of retail sales stalling out, a rise in tariffs could also result in significant increases to construction costs, which could lead to developers putting projects on hold or renovation projects being delayed for the foreseeable future. Now, anytime there's uncertainty in the market, a lot of real estate investment firms hit the pause button and take a wait and see approach when it comes to acquiring, developing, or selling properties, which could lead to another lull in transaction volume and a pullback from the increases we saw towards the end of last year. This could also lead to another slowdown in hiring at commercial real estate firms, especially for transaction-focused roles in brokerage or acquisitions. But the good news is that this will likely only be a short-term dip, and hiring will most likely pick back up very quickly once there's a little bit more certainty on what these tariffs might be. Ultimately, I'd say that today commercial real estate investors are cautiously optimistic, with the office sector finally showing signs of life, supply pressures starting to die down in the industrial and multifamily sectors, and retail still showing a lot of stability with arguably the strongest fundamentals of any asset class in the industry. So I know that's a lot of information, but I hope this is helpful if you're looking for jobs right now or trying to decide which property type you might want to focus on. And if you are looking to break into the real estate industry in 2025 and you want to make sure you have the skills you'll need to stand out in a competitive job market, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content like this on the current state of the real estate market, make sure to hit the like button and let me know. And let me know in the comments how you think tariffs might ultimately impact different sectors of the real estate industry. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.